today. So the question on everyone's mind is, how long is this going to be sustained? And what can we expect to see for the future of commodities? So with that, I'm going to welcome up Ashish Sethia, the Global Head of Commodities, Energy, and Environmental Products Research at BloombergNEF, to tell us a little bit about what is fueling these high prices and how that coincides with the net zero future.
Thanks so much, Shira. So, as Shira talked about, there are two major themes in the capital markets that we see which relate to the energy industry. The first theme, as some analysts and people in financial markets call, is a super cycle. And that term has been used a little bit in the past, but really in the last 12 months or so, this has come up a lot in research from sell side, from a lot of people looking at company valuations and so on. And the line here essentially represents the Bloomberg Commodity Index, which is a basket of commodities, including everything from copper to crude to corn. And as you can see, the prices have been rising in the last 2 years, post the pandemic, right? But what's a super cycle, right? Traditionally, it has been defined as a period of almost 10 years or so, where commodity prices continue to rise quickly. And there are two underlying parameters which drive those high prices. The first is growth in demand, almost a secular growth in demand across most commodities. And the other is a lack of investment on the supply side. And there have been two commodity super cycles in the past, one in 1970s, early 80s. Again, conditions where demand was increasing and supply was not catching up. There were supply side shocks, the Arab oil embargo, the Iran crisis, so on. And then there was the growth of China in the early 2000s post it joining the WTO, right? So the question is, are we in a third commodity super cycle, and have we seen the first year or 2 years of a commodity super cycle? Now, people who believe that there's a super cycle underway kind of point you to charts like this, which essentially tell you that investment in natural resources in general in the last 2 or 3 years has been much lower than the highs that we saw in 2012, 2013, 2014 period, right? So supply side investments are a little bit muted compared to even the recent past, if I may use the term. So that is, in most super cycles or most bull runs, that's kind of one preceding condition that you don't really have much investment on the supply side. So that argument is probably true. The other side of the story also is around macroeconomics, right? So when certain macroeconomic conditions come together, commodity prices rise. One of which is inflation, right? And some people may argue, and inflation is represented here with the red line on the left chart, inflation expectations in the US are running kind of really sky high, as some people would call it, the highest in 20 years. And some people argue that inflation increases a lot when commodity prices drive that inflation up. But some other people would argue that the reverse of that relationship is also true. High inflation causes high commodity prices, right? And actually, there was a Bloomberg News article recently, the title of which was, "This town in America has the highest inflation." Does anybody want to guess which town that was? It was Midland, right? Because it's almost impossible right now to get F-150 there at the right price, or buy frac fluid or sand, whatever you're looking at, right? So that's kind of inflation and the relation between commodity prices. They move together. There's also a bit of relationship between the US dollar and commodity prices. They also move together. When the US dollar weakens, commodity prices are relatively high because other currencies, are strengthening, particularly emerging economy currencies, and then they have a little bit more room to buy commodities. However, that relationship is a little bit broken in the last year or so. As you can see here, the dollar is appreciating, commodity prices are still holding strong, which, by the way, some commentators in markets are saying is a double whammy for emerging economies. You look at what's happening in Pakistan, what's happening in Sri Lanka, what's happening in some parts of Southeast Asia. Economies are feeling a lot of strain because both the dollar is appreciating and the commodity prices are going up as well. But in general, when these conditions come true, commodity prices go up. The effect of all of this can be seen in the markets. I think after almost a decade, you are starting to see a situation where most commodity future prices, the curves are in backwardation. And a month ago, these charts are relatively new. If I was to draw them a month and a half, 2 months ago, there was steep backwardation in most future curves, which basically tells you that people are willing to pay more for commodity now than in the future, to put it simply, right? So the markets are tight, and that's kind of manifesting itself in the form of futures prices. But what happens when the markets are tight? When the markets are already tight and you have a supply side shock, or you have a significant burst of demand for whatever reason, you see high price volatility, right? You see price volatility which is orders of magnitude higher than a market that you see in a market which is relatively loose, right? And these are kind of various benchmarks for markets in Europe. The Brent crude, TTF gas is the Dutch gas benchmark, and on the right-hand side is the European carbon price. You have seen a lot of volatility in the last 1 year. One of my analysts in London told me a couple of months ago, he said, Ashish, prices are moving in a single trading day in TTF by 20 euros a megawatt hour. The price in the beginning of 2021 was 20 euros a megawatt hour. So you're seeing volatility in intraday prices, which was a price in absolute terms of a year ago. So markets tight and volatility high, right? Pretty strong combination. However, there are people who say this super cycle will not last. And one of the major reasons for that is a potentially impending recession, right? This chart essentially shows you how many times the Fed has tightened rates in the last, since 1950s. They have done 15 rate tightening cycles, 10 of which have been followed by a recession. So only 5 times we have not had a recession after Fed has tightened rates, right? Now, there is an argument as to how steep the recession will be, how quickly the global economy will come out of it if there is a recession. I've seen some commentators saying the recession would be relatively mild, but the growth thereafter would also be relatively mild, right? So take your pick on what you want to believe. But yes, if a recession, a major one happens, then the super cycle kind of runs out of steam. But you can talk about super cycles and commodity prices and bull runs, and then many people kind of forget talking about what happens in the clean power industry as well. Some people may believe that clean power industry is relatively immune to price hikes and stuff. And yes, we as BNEF ourselves have put out these technology learning curves which go out 2 or 3 decades in the past, and kind of try and assess what the prices of various technologies and cost of power generation will be in the next couple of decades. And we have seen significant reduction in prices of solar power generation, wind power generation, battery prices, and battery deployment has increased together with it. But many of these technologies also use underlying commodities, and most of them are metals, right? And metal prices have also risen quite significantly in the last 2 years. So we are seeing a situation now where capex for solar projects in the US are 10% higher than last year. Capex for onshore and offshore wind projects are 10 to 15% higher than last year as well. So this stuff is impacting not only kind of traditional commodities or energy commodities, this is also impacting clean power in some sense. So that's essentially the first theme. The second theme is what Brent mentioned, is net zero, right? And if you look at kind of the pre-pandemic era, early 2020, only a third of global emissions were covered by countries which had some kind of a net zero target or ambition, right? Today, that number is roughly around 90%. So there has been a significant scale up in countries having some form of guidance on when they want to achieve net zero. But it's not enough to have a guidance of when you want to achieve net zero, right? The big question then is, how will you get there? And the answer to that is not very clear, but my team at BloombergNEF does this exercise called the New Energy Outlook once a year. When we did it last year, we said, rather than trying to predict how a net zero scenario would happen, let's look at potential technology choices which we think can scale up to deliver a net zero economy. And we came with 3 different scenarios. So the first one is on the left-hand side of the screen, which is the green scenario, where you see a decline in oil and coal and natural gas usage across the economy. And that's replaced largely by electrification of the economy. So you electrify as much as possible. When you electrify as much as possible, you can use clean molecules, as Brent said, and those clean molecules can come from solar and wind and batteries. But you still need, clean electrons, and you still need a clean molecule in some places, and a clean molecule can also be produced by clean power. So use basically wind and solar and use electrolyzers to produce green hydrogen, as some people would call it. So that's kind of the green scenario. You then have a gray scenario in the middle, and that gray scenario is essentially driven by the scale up of carbon capture and storage as a technology. Now, if CCS scales up, you can see that coal gets a breather post 2030, gas gets to expand a bit, oil still declines because you have electric vehicles becoming cost competitive, and you don't really have a solution for carbon capture at the tailpipe in some sense. So that's the gray scenario. And then there's a red scenario here, which is quite similar to the green scenario. So you electrify as much as possible, but you produce the electrons using nuclear power. And you produce the hydrogen using nuclear as well. So three different scenarios in some sense. But one thing is true, that maybe none of these scenarios will play out exactly the way we are kind of looking at it right now. Maybe it will be a combination of things that will happen. However, the other reality is, if a combination of these things happens, the things that we are looking at now will have to scale up quite significantly. So let me talk a bit about what things we think will scale up significantly when these two themes of a net zero and a super cycle start coinciding. So essentially, you see certain commodities which some people may call are not compliant with the net zero world, right? So you can put coal there. Even while supply of coal is not really increasing, the demand for it is not expected to increase significantly. Demand for coal has actually been quite robust in the last couple of years post the pandemic, right? But in the long term, if you look 2 decades ahead, you don't expect demand for coal to continue to rise. You probably expect demand for coal to decline significantly, right? So coal is definitely kind of not compliant with net zero. You may put crude there as well. There are certain commodities like natural gas, industrial metals, copper, aluminum, which have a role in the long term in the energy transition, perhaps. And then you have this basket of new commodities, or sustainable commodities, as some people would call it, which might emerge in the next 2 to 3 decades. So let me talk briefly about some of these. The first is electricity itself, power markets, right, in the traded sense. And as I said, we have a green scenario. If you kind of believe that the green scenario is the one which will dominantly play out when net zero happens, you are talking about electricity markets globally kind of tripling in size. So that can be a huge opportunity for a number of people. If you don't believe the world will get to net zero, we also do that exercise, and we do something called the economic transition scenario, which purely looks at the deployment of clean energy from a economics perspective. It kind of looks at what are the cheapest fuels available around the world, and kind of builds an economy around that. And so if coal is going to be cheap, 5-10 years later, it lets coal build out happen, right? But even in the economic transition scenario, the reality emerges that electricity markets will be double the size of where they are today. So you look at it either way, electricity as a technology or as a sector, and as a power as a commodity is expected to grow. The other is hydrogen. Now, hydrogen a couple of years ago was a $100 billion market, right? Now, most people believe hydrogen is the fuel which will deliver kind of that clean molecule needed in the economy, right? Wherever you can't electrify things. And you can look at various scenarios, but give or take, by 2040, hydrogen markets, purely the physical markets, would at least be $1 trillion, right? And they could be bigger, obviously, by 2050 if the technology and the fuel prices go down. So hydrogen is another interesting thing to look at. But hydrogen may not be the only fuel available to produce clean molecules or deliver clean molecules. There are other things which are slightly niche at the moment. Things like biodiesel, sustainable aviation fuel, renewable natural gas, all of these fuels also are expected to go multiple folds. That said, though, I always like the example of sustainable aviation fuel. You see almost like an exponential growth there. But even in 2050, even after that growth, sustainable aviation fuels will only deliver 6% of the total jet fuel demand. So they are not the prime solution in our thesis right now, unless supply really, really scales up by orders of magnitudes very, very quickly. But clean fuels beyond hydrogen also have a role to play. Then there are carbon markets. I first worked in carbon markets back in probably 2006, 2007. Lot of euphoria because the EU emissions trading scheme was just about to be launched. And corporations were starting to buy these credits in the voluntary carbon markets as well. Many people don't realize this. Carbon markets today are, in 2021, were almost $850 billion. So they are massive. But in the US, if you look at the East and West Coast compliance markets, they're only $50 billion worth of value. The biggest value comes from the EU emissions trading scheme, right? It is big and it is growing, and the market's getting tighter. The voluntary carbon markets, huge amount of euphoria because all these companies that are around the world that are taking net zero targets will have to buy a certain amount of credits from the voluntary market. But in terms of value, they're still only $1 billion. So there's a long way for them to go to attain a massive size. But if you look at all of these commodities and believe that they will grow quickly, that's one part of the equation. As I said, looking at the physical markets is one thing, but if you're looking at any traditional commodity like natural gas or oil, you see a situation where the paper market is much, much bigger, right? Orders of magnitudes bigger, right? So the problem that some of these new commodities right now have is they're not really parts of any major commodity benchmarks or indexes. So even the Bloomberg Commodity Index does not have the European gas as part of that benchmark. It does not have carbon as certain parts of carbon markets as part of that benchmark. So for financial investors to kind of invest in some of these commodities, they have to slowly and steadily become parts of some of these major benchmarks. So two scenarios that can emerge for commodities. One is, demand peaks, declines thereafter, and then unfortunately, you may have a situation where commodity prices for these traditional commodities remain high because supply side investment is lacking. Even if demand plateaus and declines thereafter, you have really supply side investment not going up at all or declining, because of which production from existing capacity declines. And so that delta between demand and supply keeps prices high. On the other end of the spectrum, you have things like lithium, where demand is going to grow so fast that supply is always almost playing catch up, right? So, these commodities, new commodities will also have their own cycles, but in a long-term trend perspective, you would expect prices of these things to go up a little bit. So if you are, let's say, a traditional natural resources company and looking at these different kinds of commodities emerging, how do you take your capital investment decisions, right? How much money are you going to invest in these new things? And if you have decided to invest a certain amount of money in the new things, what new things are going to look at, right? So let me talk maybe for the last 5 minutes on how we think this capital allocation situation playing out. I did this survey in the New York summit that Christian mentioned in the beginning, the BNEF summit in New York in April. And I asked people why oil and gas companies are investing in the energy transition. And I was pleasantly surprised that at least 45% of them said they're investing in the transition because it's a massive investment opportunities, and some of the things that the oil and gas companies are doing have synergies with their existing capabilities, right? Obviously, there are 55% people in the room, each of which are experts in their own right in the energy industry, which said this is happening because they have investor pressure or their fossil fuel divestment commitments, or they see peak demand for their traditional products happening in the next 10, 20 years, right? So two kind of camps there. But once you have decided to invest, the number of options that exist to invest in the energy transition are already quite high and increasing, right? You can do solar power, you can do wind power, you could invest in battery manufacturing, you could do hydrogen, you could do biofuels, you name it. There are probably more than 24 options available right now for you as an organization to look at. And these are just sectors. If you look at supply chain of each of these new sectors, it becomes even worse, right? So again, I asked the audience the question as to what should oil and gas companies focus on when they're looking at the energy transition? Where should they invest their capital? And 85% of the people said they should do that in the clean molecule space. Only 15% of the people said they should look at renewable power generation or EV charging and so on. Most of the people basically said let oil and gas companies focus on hydrogen, biofuels, carbon capture and storage, right? So interesting message there. However, I did this survey in New York. If I would have done this in London, the results would have definitely been quite different. And I say that because essentially, if you look at the strategies of the oil and gas companies in terms of their investment thesis in the energy transition, on the one end of the spectrum, you have major US companies who are investing in the parts of the energy transition which sits well with their core business. So they're doing hydrogen, they're doing carbon capture, they're doing biofuels, but not really trying to become big power producers using solar and wind as a technology. And you have the European majors on the other end of the spectrum. They're doing everything possible from batteries to hydrogen to carbon capture and storage and investing a lot of money while doing so. So quite different strategies emerging there. Almost 6.5% of oil and gas industry's capex was invested in the energy transition last year. That's an all-time high. In absolute term, that number is $21 billion, right? So 6.5% of the industry capex went into the transition last year. But if you break this number down by companies or type of companies, you see a very clear trend. As I said, the European majors are leading, but refining companies around the world, including here in the US, are also starting to invest a pretty meaningful amount of their capital every year in the energy transition. And the laggards are essentially US E&Ps, integrated oil companies in the US, and Asian integrated oil companies as well. So kind of a clear trend emerging there. And finally, I asked people that if it is 6.5% today, what can this number look like by 2030? I was pleasantly surprised that 88% of the people said it will be 25% or higher. And the sizable amount of population in this sample basically said oil and gas companies will invest at least 25% of their capex in the energy transition by 2030. I think, well, I'm not sure, where I would place my own bets, but this is a sizable jump. It shows confidence that the industry is evolving and is looking at the transition seriously. So I would end there, and I'll give it back to Shira.
Perfect. Thank you, Ashish.